You have been staring at a chart that keeps going lower, your account is bleeding, and every instinct in your body is screaming at you to sell everything and walk away forever. But what if that exact moment is the one you have been waiting for your entire trading career? Most traders quit right before the market hands them the biggest opportunity of the year. And the reason is not because they lack skill. It is because they cannot read the language the market speaks when it is about to reverse from the bottom. The market bottom is not a random event that happens by accident. It is a structured process with fingerprints, patterns, and signals that repeat across every asset class, every time frame, and every market cycle if you know exactly what to look for. By the end of this script, you will understand how to identify a real market bottom before the crowd does, how to position yourself with precision, and how to stop making the emotional mistakes that have cost you money every single time price touched a low. The first thing you need to understand is that a market bottom is not a price level. It is a behavioral event that occurs between buyers and sellers, and when you start seeing it through that lens, everything about your analysis will change permanently. Retail traders look at a low price and think the market is cheap. Institutional traders look at the same price and ask a completely different question. They ask who is in pain, who is being forced out, and what happens to price once all that forced selling is exhausted. When a market falls for an extended period, the sellers who are in control are not random participants. They are heavily leveraged traders getting margin called. They are fund managers liquidating positions to meet redemptions, and they are retail traders panic selling after watching weeks of loss. Once all of those forced sellers have exited the market, there is nobody left to push price lower. And that moment of seller exhaustion is the technical foundation of every single significant market bottom you will ever study in the history of price charts. The first signal you watch for is a volume climax. This is a candle or a cluster of candles where volume is significantly higher than anything you have seen in the prior weeks. And this surge in volume represents the final wave of panicked selling hitting the market all at once. A volume climax does not mean the bottom is confirmed the instant it happens. It means the process of capitulation has begun, and you are entering the zone where the most important price behavior of the entire downtrend is about to unfold over the next several sessions. After the volume climax candle, price often snaps back sharply within the same session or the very next one. This is called an automatic rally, and it happens because the institutional buyers who are waiting with limit orders absorb all of that selling and push price back up quickly. The automatic rally does not last long. It is not meant to. It is simply the first sign that there are serious buyers in this price zone, and it gives you the first upside level that the market will need to reclaim later for the bottom to be confirmed as legitimate and sustainable. After the automatic rally fades, price will come back down toward the area where the climax happened. This is called the secondary test, and this is where most retail traders make one of the worst mistakes in all of trading by thinking the market is about to crash to new lows. The secondary test is healthy, it is necessary, and in fact a weak secondary test where price cannot even reach back to the original low is one of the most powerful bullish signals that exists in all of technical analysis, because it tells you the sellers have genuinely lost their momentum. Watch the volume during the secondary test with intense focus. If the volume is significantly lower than it was during the climax candle, that divergence is telling you that the selling pressure is drying up and the balance of power is quietly shifting from sellers to buyers. Price can oscillate several times between the low of the climax and the top of the automatic rally. This range is called the trading range or the accumulation zone, and what is happening inside it is that large institutions are systematically buying supply from panicked sellers at the cheapest possible prices. Smart money does not buy in one single massive candle that everyone can see on the chart. They buy gradually and patiently over days and sometimes weeks so that they can accumulate large positions without driving price up before they are fully loaded and ready to push the market higher. The way you identify accumulation versus distribution inside a trading range is by reading the relationship between price spread and volume. When you see narrow candles on high volume, it means the market is absorbing supply. When you see wide candles on low volume, it means the buying is meeting very little resistance. Spring is one of the most important and misunderstood concepts in all of market structure analysis. It happens when price briefly dips below the low of the trading range, triggers all the stop losses placed by traders who went long inside the range, and then reverses sharply back inside the range. The spring looks terrifying because it makes a new low, and every indicator you are using will flash red and tell you the downtrend is continuing. But the spring is actually the market doing its final shakeout to remove weak hands before the real move higher begins. A spring followed by a strong reversal candle with expanding volume is one of the highest probability setups in professional trading because it tells you that the large large operators have tested the downside, found no real selling pressure, and are now ready to push price aggressively to the upside. Not every bottom will have a perfect spring. Sometimes the market builds a higher low inside the trading range without ever breaking the initial low, and this type of base is actually stronger in many cases because it shows that the buyers are so dominant they do not even need a final shakeout to clear out the sellers. After the spring or the final higher low, you watch for what is called a sign of strength. This is a wide range candle that closes near its high, moves price back toward the top of the accumulation range, and does so on volume that is noticeably higher than what you saw during the down moves. Inside the range, the sign of strength is the institutional footprint. It is the market showing you that the buyers are in complete control, that the supply in this zone has been absorbed, and that the path of least resistance has officially shifted from downward to upward for the first time in the entire move. After the sign of strength, price will often come back for what is called the last point of support. This is a shallow pullback to the top of the old trading range, which is now converted from resistance into support, and this pullback is your final and highest probability entry before the sustained uptrend begins. The last point of support is where professional traders take their largest positions. Because the risk is clearly defined, the stop goes just below the accumulation range. The reward is the full move higher that the institutional buying has been setting up for the entire time price was in that range. Now let us talk about the indicators that most traders use incorrectly when trying to find bottoms. RSI is the most common one and also the most misread because traders see an oversold RSI reading and immediately assume the market must reverse. But oversold can stay oversold for a very long time in a strong downtrend. The correct way to use RSI at a market bottom is to look for bullish divergence, which means price makes a lower low, but RSI makes a higher low. And this divergence tells you that even though price is still falling, the momentum behind the selling is weakening and running out of fuel. Divergence alone is not an entry signal, it is a warning signal that the downtrend is losing energy, and you combine it with the structural analysis of volume climax and trading range behavior to build a complete picture instead of relying on any single indicator in isolation. MACD divergence works on the same principle. When price is making lower lows, but the MACD histogram is printing shallower troughs, the math inside the indicator is telling you that the gap between the fast and slow moving averages is narrowing on each new low, which is a momentum signature of exhaustion. Moving averages are nearly useless for identifying the exact bottom, but they are very useful for confirming that a bottom is in place once the structure is formed. When price reclaims the 20-period moving average on the daily chart and the moving average flattens and begins curling upward, the trend change is being confirmed by the averages. The Fibonacci retracement tool gives you price magnetic levels where bottoms tend to cluster. The 61.8% and 78.6% retracement levels from any significant prior swing high to swing low are statistically the most common areas where institutional buyers step in and defend price with serious liquidity. When a volume climax happens right at a 61.8% Fibonacci retracement, and you also have RSI divergence, and the candle is a hammer or a pin bar, you are looking at multiple independent confluences all pointing to the same thing. And confluence is the single most powerful concept in technical analysis. Market bottoms also frequently occur at or near long-term horizontal support levels. These are price levels where the market has respected a floor multiple times across months or years. And each time the market retests that level, the institutional memory of prior buying at that zone creates a self-fulfilling defense. When price reaches a major historical support level after a significant decline, and you begin to see the accumulation behavior we described, the trading range, the volume climax, the spring, you are in the highest probability bottom identification setup that the market ever offers to traders who know what they are looking at. Sentiment indicators are an incredibly powerful complement to price structure analysis, and the one that professional traders respect most is the put-to-call ratio. When this ratio reaches extreme levels, it means the options market is saturated with bearish bets, and markets historically reverse when pessimism reaches that level of consensus. The American Association of Individual Investors Sentiment Survey is another data point worth tracking. When the percentage of bearish respondents exceeds 55%, it has historically been a contrarian buy signal with impressive accuracy across multiple decades of market data going back well. Before the internet trading era, fear and greed index readings below 20 are not automatic buy signals, but they tell you that the emotional environment is ripe for a bottom to form, because extreme fear means that almost everyone who wanted to sell has already sold and the marginal seller has been exhausted from the market. News sentiment at a genuine market bottom will be uniformly horrible unpredictable. You will see headlines predicting further crashes, analysts on financial networks will be discussing worst-case scenarios, and this uniformly negative media coverage is actually one of the most reliable contrarian signals that a bottom is near. The market discounts future events approximately 6 to 9 months in advance, which means that by the time the economic data is at its worst, the stock market has very often already bottomed and started moving higher, which is why waiting for good news to confirm your buy is almost always buying the top of the recovery move. Breadth indicators give you a view of what is happening under the surface of the market that price alone cannot show you. The advanced decline line measures how many stocks are participating in a move, and when the advanced decline line makes a higher low while price makes a lower low, that breadth divergence is a powerful bottom signal. New 52-week lows on the NYSE reach a peak before price reaches its final bottom in many significant market turning points. This means the number of stocks making new lows starts contracting even as the major index is still declining, and that internal strength is the market telling you the damage is becoming contained. When you start seeing former leading sectors stabilize and stop making new lows while the broader index is still falling, pay close attention, because sector rotation out of defensive holdings and back into growth or cyclical areas often begins at the exact price zone where the bottom is being formed. Interest rate behavior and credit spreads are macro-level bottom signals that many equity traders completely ignore. When high-yield credit spreads begin to narrow after a period of expansion, it means the credit market is seeing reduced default risk, and equity markets almost always follow. Credit market signals within a few weeks. The dollar index relationship to risk assets is something every trader must understand. A weakening dollar at the same time equity markets are making their final lows is a powerful combination signal, because a falling dollar reduces financial stress globally and increases the attractiveness of risk assets denominated in dollars. Commodity markets provide additional confirmation at equity bottoms. Copper in particular is sensitive to global growth expectations, and when copper stops making new lows and begins to stabilize while equity markets are still testing their bottom zone, the industrial metal is giving you a forward-looking signal of economic stabilization. Position sizing at a suspected market bottom requires a completely different approach than position sizing during a clear uptrend, because you are entering before the move is confirmed and the probability of being early is real, which means you begin with a partial position and add only as the structure confirms. The first entry at the climax candle area or during the spring should be your smallest position, perhaps 25 to 30% of your intended total size, with a stop below the climax low, and you add the next portion after the sign of strength and a final portion at the last point of support. This pyramid approach to building a bottom position means that your average entry price stays in a favorable zone, your risk per share is defined at every step, and you are never fully exposed if your initial read turns out to be wrong and the market decides to make one more leg lower before the real bottom. Time is a variable that most traders do not factor into bottom analysis, and it is one of the most important. A legitimate accumulation base needs time to fully transfer shares from weak hands to strong hands, and a trading range that is only 2 or 3 days old is almost never sufficient for a bottom of any significance to be in place. The wider and longer the accumulation trading range, the more powerful the eventual breakout from it will be, because more supply has been absorbed and more institutional buying has occurred, creating a situation where when the move finally begins there is very little resistance standing between price and much higher levels. False bottoms are the most dangerous trap in all of trading. A false bottom occurs when all the surface signals appear correct, but the underlying supply has not truly been absorbed. And the way to distinguish a false bottom from a real one is by watching what happens when price attempts to break out of the trading range. A legitimate breakout from an accumulation range happens on expanding volume. It closes near the top of its range. It does not immediately fail back inside the range the following session, and the pullback that follows the initial breakout finds support at the top of the range rather than collapsing back through it. A false breakout from a range that has not truly absorbed supply will show you a wide-up candle on high volume, followed by a narrow range or a down candle the very next session, and that failure to follow through is the market showing you that supply is still overhead and sellers are still in control of the structure. Higher time frame context determines whether a local bottom you are analyzing is a minor bounce within a larger downtrend or the actual major bottom of the entire move. And this distinction is everything, because trading a bounce in a major downtrend with a bottom trading strategy is one of the Most reliable ways to destroy a trading account. Before entering any bottom trade, go to the monthly and weekly chart and honestly assess where price is within the larger structure. If the weekly chart shows a clear downtrend with no sign of stabilization, and you are trying to call a bottom on the daily chart, you are fighting the dominant time frame, and the dominant time frame wins almost every time. The best bottoms to trade are the ones where the monthly and weekly charts show you a long-term support zone, and the daily chart is showing you the accumulation behavior inside that zone. The alignment of structure across multiple time frames creates a situation where the probability is genuinely on your side. Managing the trade after the bottom is identified is as important as identifying it correctly. Once you are in a confirmed position and price is trending higher, you move your stop to just below the last point of support level so that you are protected from a failed breakout while still giving the position enough room to develop. Taking partial profits at natural resistance levels, at prior swing highs, at measured move targets calculated from the height of the accumulation range, these profit-taking decisions should be planned before you enter the trade so that greed does not cause you to hold a winning position past the point where the evidence supports holding it. The psychological difficulty of trading a real market bottom cannot be overstated because everything in the news is negative, your friends think you are making a terrible mistake, your account has probably taken losses during the decline, and every emotion you have is pushing you toward selling rather than buying. Professional traders train themselves to recognize the emotional discomfort at a market bottom as a signal rather than as a warning. The discomfort is telling you that you are doing something the crowd is not doing, and in trading the crowd is almost always wrong at the extremes of fear and greed where the real money is made. Journaling every bottom you identify, whether you trade it or not, is the practice that separates traders who develop genuine skill from traders who stay at the same level for years, because the journal forces you to record your reasoning, your observations, and your outcome so that you can study your own decision-making over time. Go back through every major market low in the charts you have access to and annotate exactly where the volume climax occurred, where the spring happened, where the sign of strength appeared, and where the last point of support was, because that visual repetition will build a pattern recognition, skill that no book or course can give you. The market will always give you another bottom to trade. The cycle of accumulation and distribution repeats constantly across all time frames and all asset classes, and the trader who commits to mastering the language of price and volume at extremes is the trader who will still be in this game 20 years from now with a growing account. Stop looking for the magic indicator. Stop looking for the secret strategy that nobody else knows. The traders who consistently identify and profit from market bottoms are not smarter than you. They are simply more disciplined in their observation, more patient in their waiting, and more honest with themselves about what the chart is actually telling them versus what they want it to say.